The market is currently open and Opendoor Technologies Inc., Open, is trading at a live price of 5.19, reflecting a positive intraday movement of approximately 1.97%. The immediate takeaway from this figure is not the modest percentage gain, but the remarkable volatility and the context of the price itself. What many casual observers might miss is that this price point represents a staggering multi-100% surge from its 52-week lows, an astronomical rise that has more to do with a fever-pitch speculative narrative than any fundamental business transformation. The expectation is that this movement is a result of a major turnaround. The reality, however, is a far more complex and fragile story of shifting business models, macroeconomic headwinds, and the intoxicating power of the retail trading community. This isn't a story of a business simply improving, it's a dramatic conflict between a company's operational reality and the market's psychological projection of its future. The iBuyer narrative. The general belief about Opendoor is that it is the quintessential iBuyer, a company that leveraged technology to disrupt the traditional real estate brokerage model by providing instant, all-cash offers for homes. This was the narrative that propelled it to a post-SPAC valuation of over $18 billion. The deeper reality, however, is that this model, while appealing in theory, is inherently vulnerable to market cycles. The business requires immense capital to buy homes, which it then must hold on its balance sheet until it can sell them, ideally at a profit. This works when the housing market is appreciating rapidly, but when prices stabilize, or, worse, decline, Opendoor is left holding depreciating assets while its carrying costs, the interest on its debt, continue to accrue. The current macroeconomic climate, marked by persistent high interest rates, is the antithesis of the environment in which the iBuying model thrives. This is why we have seen the company's stock plummet from its highs to below $1 at one point, and it's why its recent ascent is so puzzling without understanding the speculative forces at play. Stock movement. Volume. Looking at the most recent stock movement, the intraday price action of Opendoor tells a story of significant daily swings. While the current price is up, it has touched a high of 5.4 and a low of 4.97 today alone, a testament to the extreme volatility that has become its trademark. Trading volume remains elevated, far exceeding its average, a clear indicator of intense investor interest and, crucially, high turnover. This isn't passive, long-term accumulation. It's active, high-frequency trading. Institutional activity provides a fascinating and often contradictory counter-narrative to this retail-driven frenzy. Recent filings show a mix of institutional buying and selling, but the most telling data point is the significant reduction in shares held by major institutions like Vanguard and BlackRock in the most recent quarter. While some new hedge funds have initiated positions or added to them, the overall trend from the largest, most established holders has been a move toward the exit. This suggests that the smart money is taking profits and reducing exposure, while the retail-driven enthusiasm continues to fuel the momentum. This divergence is the heart of the tension in Opendoor's stock right now. The small-scale investors are buying into the turnaround story, while some of the largest players are getting out, creating a liquidity event that a narrative-driven market is eagerly consuming. Q2 2025 Earnings Recap. The recent Q2 2025 earnings report provides a critical look at the underlying business performance that the stock movement may or may not be reflecting. On the surface, the numbers were mixed. Revenue of $1.6 billion beat analyst expectations, and the company even returned to positive adjusted EBITDA for the first time since 2022. This was the headline that many latched onto, as proof of a fundamental turnaround. However, digging deeper reveals a different picture. The guidance for the third quarter was a sharp contraction, with revenue projected to drop significantly to between $800 million and $875 million, well below analyst consensus. This is a crucial point that was largely glossed over by the market's bullish reaction. Management explained this was due to a strategic shift, prioritizing margin discipline over volume, but it also reflects a challenging market where Opendoor is purchasing fewer homes, just 757 in the quarter, a sharp decline from the previous year. This deliberate slowdown is a direct acknowledgement of the hostile operating environment. Yet the stock's reaction was largely to ignore it in favor of the short-term, positive EBITDA headline. Business model reality. At its core, Opendoor's business model is a simple but capital-intensive one. buy homes directly from sellers using its proprietary valuation algorithm, perform minor renovations, and then resell them quickly for a profit. The company generates the vast majority of its revenue from these home sales. The expectation was that this tech-enabled process would be more efficient than the traditional real estate model. But the reality is that the margins are razor-thin and highly sensitive to market fluctuations. Its past performance has been a roller coaster, directly tied to the housing market's health. During the pandemic-era real estate boom, the company saw explosive growth, but the subsequent downturn exposed the fragility of its model, leading to massive losses and a stock price collapse. The company's attempt to pivot toward a more asset-light model, including its partnership with real estate agents, is an attempt to de-risk its balance sheet and improve profitability. This is where the future of the company truly lies. But it is a fundamental shift that is not yet fully reflected in its current financials or its stock price, which is still largely moving on the back of its old, more speculative, iBuying narrative. Future outlook. Looking ahead, the future outlook for Opendoor is defined by a delicate balance of potential catalysts and significant risks. Catalysts. A shift in the macroeconomic environment, specifically a drop in interest rates. A successful and profitable pivot to its new asset-light model. The speculative fervor and high short interest could trigger a short squeeze. Risks. The Q3 guidance is a stark warning of a challenging road ahead. If the housing market stagnates or softens, inventory could become a major liability. The ongoing CEO's search after the departure of its co-founder adds uncertainty. Retail sentiment-driven price action makes it vulnerable to a sharp correction. The question isn't if the stock will be volatile, but whether the business can ever catch up to the valuation the market has placed upon it. Investor. Question. What do you think will happen first? A dramatic drop in mortgage rates? Or a severe correction in the housing market? Comment below with your thoughts and predictions. Final summary. In summary, the story of Opendoor is a powerful study in the disconnect between market expectation and fundamental reality. The expectation, fueled by a narrative of a tech-enabled disruptor and recent positive headlines, is one of a company on the verge of a major turnaround. The reality, however, is a company facing a brutal operating environment, a capital-intensive business model that is struggling, and a share price propelled by speculative trading rather than sustained profitability. While the recent return to positive adjusted EBITDA was a psychological victory, the company's own forward-looking guidance paints a much more somber picture of a strategic retreat, rather than a forward charge. Until the company can prove its new business model is viable and profitable, or until the macroeconomic environment provides a genuine tailwind, the price will likely continue to be driven by narrative and sentiment, not by the underlying business fundamentals. This is an investment defined by its inherent tension, and for now, reality is still chasing expectations.